most familiar with John's work, so I'll let him do most of the talking, give a little detail on the background. My name is Jerry. As I mentioned before, I'm one of the principals here at Photon Trader Services and also FuturePath Trading. We offer online trading software and education, part of what we're doing today. FuturePath Trading is an independent introducing broker, and we provide brokerage services for futures traders. During today's presentation, John is going to talk a little bit about one of the many new things he is working on, and that's taking a new approach to an old indicator, the Relative Strength Index, the RSI. In addition to working on that, he's got a 3-day trading workshop coming in up in October in his backyard in San Simeon, California. And he's also preparing to release a leader-follower futures program. And that's in conjunction with us here at FuturePath Trading. So we're very excited about all of those things, and I think he's going to touch on some of them this afternoon. Again, we're going to put up the futures risk disclosure. You've all seen this, but it's very important to understand that the risk involved in futures trading and options, and appreciate that where there is opportunity for profit, there is also a risk of loss of capital. I am going to turn the session over to John. Please feel free to go ahead and type some questions in if you've got them in the question box, and we'll try to get them answered. If for some reason we don't get to it, we'll certainly try to go back and catch them and give you a direct response if that's appropriate. Hello, John.
Yes. Hi, folks. Well, thank you for joining us this afternoon. I hope to bring you some information that you'll find interesting and profitable. I will be talking about a different look at the RSI. I know it's been beaten into submission by many authors, and so I'll just add my name to the list. When I started trading over 40 years ago, I was using fundamentals, chasing rain clouds through every cornfield in Iowa. And at that time, Wells Wilder wrote his book, New Techniques, something. In that book, he developed the RSI indicator. And I asked my broker, why did Wilder use 14 days in his calculation of the RSI? And the broker said, because Wells Wilder said to. And you have no idea how dissatisfying that is to an engineer. So that began my 40-year odyssey in finding optimal digital signal processing techniques and trying to bring a little bit of science into this art of trading. And so that was my introduction. My first question to be answered was, what is the correct length of data to be used in an RSI? And I found the answer, which I'm going to share with you. And then later on, I found that also the upper and lower thresholds, there were lively debates bordering on religious fervor about what is the correct threshold. Is it 10 or 20 and 80%, or is it 30 and 70%? Well, actually, it's not that critical. It depends upon how you use it, and both of these dimensions, the horizontal dimension, how much data you use, and the setting of the upper and lower thresholds are subject to variations. So let's jump into it and see why. I'm going to give you the engineer's approach to looking at the RSI indicator. In order to do that, we have to do a little bit of algebra. So bear with me, and let's go through the algebra. And I call it my RSI. When Wells first described the RSI, it was a function of his relative strength, which was an average of the closes up to the average of the closes down. The closes up, that meant it was a positive number. If the close today is higher than the close yesterday, that was a close up, and the value of that difference was added to the accumulation. And in a similar fashion, the closes down was a positive number if and existed only if the close yesterday was higher than the close today. Since an average is the accumulation over the given period, Wells used 14 bars, is divided by 14, and the 14 cancels out in the RS ratio. So we're just looking at a ratio of RS as accumulation of closes up to closes down. And Wells defined the RSI as shown in the left and top, 100 minus 100 over 1 plus RS. Well, 100 is just converting the ratio to a percentage. And so the Wilder RSI varied from 0 to 100%. But I want to do a little bit of substitution. I'm going to substitute that ratio of closes up to closes down in for RS. And so in the second line of code, I go through that algebra, clearing common denominators, and end up with the equivalent formulation that the RSI is the accumulation of closes up over the sum of closes up plus closes down. In other words, it's all the closes, in other words. So you can see that if you have only closes up, that is you're in an uptrend, for example, the ratio is closes up over closes up, and so the value of the RSI is 1. And if you have only closes down, that means the numerator is 0, the closes up, or there are no closes up, and so the RSI value is 0. Hence, RSI goes from 0 to 1. But in this formulation, you get a different insight into how to set the data length that you're going to use for an RSI. For example, if you use 1 bar of data, 1 bar back, that means that close is either a close up or a close down. And so as you go along through time, the RSI is going to jump from a value of 0 to a value of 1 and back down. And it's going to be very, very fast jumping limit to limit. So obviously a 1 bar data length is way too short, and it results in saturation at the limit of the indicator. On the other hand, let's take it to a logical extreme, and suppose we have 1,000 bars in our calculation. So the chances are that over a length of 1,000 bars, that the closes up are on the average is going to be something similar to the closes down. So in other words, it averages out, and your indicator, the RSI indicator with that long length of data, is just going to sit there in the middle point at the average. So somewhere between 1 bar and 1,000 bars is the correct length of data to use. Now, in this formulation, I would also ask you to conceive of a sine wave. And the difference between the cycle valley and the cycle peak of a pure sine wave is a half a cycle. And so that is the maximum strength that you would get for a cycle in the market. And it turns out that that is in the correct length of data to use in an RSI, which is half the dominant cycle. You can, if you don't have a way to measure the dominant cycle, you can estimate it. And it goes like this. All you have to do is start with a data length that you know is way too short, 3 or 4 bars, and then keep increasing the length of the data used in the calculation until the RSI stops being saturated at the upper and lower limit. And when it tends to fall off the limits, both at the top and the bottom side, that's about the right length of data to use. You kind of identified the dominant cycle in the market through that technique. I prefer to look at the RSI in still a different way. It swings from 0 to 1 in this ratio formulation, but oscillators tend to be centered on 0, from -1 to +1. So in order to do that, if it swings from 0 to 1, we multiply it by 2, and so it'd swing from 0 to 2. And then if we subtract 1 from that, we got the same oscillator that swings from -1 to +1. And so that's exactly what I've done on that next to the bottom line. I multiply the first formulation by 2, and I subtract 1 from it. Turn the crank on a little algebra, and the conclusion I reach for a RSI, it's my RSI, this swings from -1 to +1, is the accumulated closes up minus the accumulated closes down over the sum of the accumulated closes up and closes down. And so you can see by the same test, if you have only closes up, there are no closes down, and so the ratio is 1. If there are only closes down and no closes up, the ratio is -1, and so we have an oscillator that swings from -1 to +1. I prefer this because we can do things with an oscillator that swings from -1 to +1. And that's what I'm going to show you in code. And please bear with me. If you don't have to write this code down, if you want to get the text file of this code, there is my email address at the top, and I'd be happy to send you a copy of the code in text format. The code happens to be written in easy language, but it's not hard to translate it. In fact, I'll describe what's going on, and so you might be able to if you're writing in C+ or some other code that you're more familiar with, it's not very difficult to translate this over. I don't use any hidden functions or anything like that, or hard to translate. So I'm going to start in the middle of the code. You see right here where I reset these I set the closes up and closes down to 0, and then I accumulate over the entire length. If the fill of today minus the fill yesterday is that's the count 1 bar ago, over this range is greater than 0, then I accumulate the closes up. And if the filter of the count today is less than the filled count 1 bar ago, then in the less than sign there, so the closes down accumulate. So I've got an accumulation of the closes up that closes down. And if I don't have a 0 in the denominator, then my indicator is just the code that I derived on the previous page. Closes up minus closes down over closes up plus closes down. That's it. That's all there is to it, except that you probably want to smooth the indicator. It's kind of, the accumulation doesn't do a great job of smoothing. And so you want to put another filter on it. And your choices are to filter before you do the RSI accumulation. So you're not literally doing closes up. You're taking differences in the filter output. Or you can do the filtering after you do the my RSI calculation. The two are not exactly equivalent because the RSI itself is a nonlinear transfer response. For equivalent filtering, you'll get the same 0 crossings, but the shape of the indicator will be a little bit different. I prefer to do filtering, smoothing at on the data before I do the RSI, because that enables the RSI itself to make a full swing from -1 to +1, which I'm going to take advantage of afterwards with a Fisher transform. We'll get into that a little bit. So my smoother is a filter that I call my super smoother. You can read about it in my books. But in code, what you do is you calculate these coefficients, these variables, and I do that once that's done for all time throughout the code. And then after the first operation I do after that is to create a momentum function, which is the close minus the close over the RSI length. And that momentum function, what that does, that puts a 0 in the transfer response at half the dominant cycle. And in other words, it puts a maximum of the transfer response at the dominant cycle. And it also helps notch out higher frequency noise at cycle periods shorter than the half dominant cycle. So it's a little bit of a noise limiting effect, and it also, the momentum function also assures that I have a 0 in the transfer response at DC or 0 frequency. So now I know I don't have a distortion due to any trend effects in my data. So after I smooth it, I apply the RSI, and now I have an RSI that swings between +1 and -1. But if I want to put that into a Fisher transform. Now, what a Fisher transform does, regardless of the probability distribution of the oscillator going into it, if it's swinging between -1 and +1, it will convert the probability distribution to be almost Gaussian, or a normal bell-shaped probability curve. In other words, if your original indicator had what they call fat tails, it will put more of the data near the center. And so if you measured the probability distribution after the transform, it will look more like a bell-shaped curve. But we can't let, there's a thing about the Fisher transform, it's going to convert it to standard deviations. So your vertical scale of your indicator will be in standard deviations, but you can't let it go, you can't use exactly 1 or -1, or the Fisher transform will blow up. So we'll limit the RSI to -0.999 on the low end and +0.999 at the upper end. That limits it to 3 standard deviations. And so the next equation, applying a Fisher transform to it, you get is a straightforward equation, also described in greater detail in my books. But what I call the rocket RSI converts my RSI to an indicator having a Gaussian probability distribution on the vertical scale. So now what we have through the momentum function is an indicator where we have correctly adjusted for the horizontal period, that is the amount of data we use in our look back. And now we have the vertical scale scaled in standard deviations. And when we do that, here's one example of it. On SPY, you can see that for sure that the peak are clearly identified. Now, I'll comment on the vertical scale. Once you go to 2 standard deviations, that's about the 97.5% point. So once you're in that region, we can, it's a pretty good probability you're going to have a reversion to the mean. So exceeding a standard deviation of 2 to 1 is an indication of a reversal and a time to go the other way. And that's, I'll take a little step back. Conventional wisdom regarding the RSI is that once, I'll take it on the long side, once the RSI is crossed below the lower threshold, it's in a, quote, oversold condition, unquote. And you want to wait until it crosses back over, say, the 20% point before you jump in. Well, that's exactly the wrong thing to do. And here's why. In daily data of index futures, take my word for it, there is a more or less persistent monthly cycle in these indices. And a monthly cycle is about a 20-bar cycle. So keep that in mind. So when you're doing these indicator calculations, they introduce lag from the real data. And to calculate a useful RSI, your lag is going to be, by the time you do the smoothing filter and do the RSI calculation itself, your lag is going to be on the order of 3 or 4 bars. And now if you look at the swing, wait for it to cross back up again over that 20% point, you're going to wait for that. You're waiting for confirmation is the conventional wisdom. And when you wait for confirmation, you've waited another 3 or 4 bars. And then after you get that indication, you wait 1 more bar after you get the signal to make your entry on the next day. Well, you've waited between 7 and 9 bars on a cycle period that is 20, in other words, 20 bars. In other words, it's 10 bars in real data from the cycle bottom to the cycle top. So by the time you go long, the real data is almost at the top. You're almost exactly wrong. And so using a conventional RSI, I think I know a far better approach is to anticipate the turning point. That is, you necessarily have the 3 or 4 bars of lag of your calculation of the indicator. But what you do is you take your long position when the RSI, my RSI, crosses under the lower threshold level. That is, you're anticipating a turning point so that 3 or 4 bars of lag that in your indicator is canceled by a 3 or 4 bar anticipation of the turning point. And then you have the 1 bar lag. So you're getting in roughly at the right time if you anticipate the turning point. That's kind of a crucial point. I've written papers on it and with the studies showing the equity curves doing it both ways with nothing else in the indicator. And it's just hands down better to anticipate turning point. But you can anticipate the turning point using this interpretation. You know that it's marked in standard deviations, and so it's a high percentage turning point when it doesn't have to peak up to the 3 deviations. By the time you get to 2 standard deviations, you're ready to make a turn to the opposite direction. You'll be a little bit early sometimes, sure, but that's called trading. And you can just visually line up the peaks of the rocket RSI with the turning points in the data and see that it's by and large right on, spot on. So this is the rocket RSI. It is just one of the topics I'm going to be talking about in my October workshop. I have a 3-day workshop coming up October 12th through 14th here in San Simeon. That's halfway between San Francisco and Los Angeles. Hearst Castle is right here. So I'd invite you all to come on out. There's lots to do in tours of Hearst Castle, Big Sur. We have our unique elephant seals right here on the coast. But more importantly, what it's going to mean to your trading. We're going to spend it's an intensive learning experience for you. I'm going to get into the spectral structure of the market. I show you how the data is characterized and how you have to take into account the natural fractal characteristics of the market in your indicator, because if you don't do it, your indicator is going to lead you astray. And I know a fair amount about digital signal processing, but in order to use it in trading, we have to keep it really, really simple. And the reason we have to keep it simple is because anytime we do fancy calculations, it takes data to do and therefore introduces lag. We are forced to use a minimum amount of data to minimize our lag in our indicator, and therefore the digital signal processing have to be really simple, but they are impactful because the approach from an engineer's perspective, you'll leave knowing what the absolute best possible case can be. And that will be demonstrated. So we'll do that a couple different ways. First of all, we'll have indicators that use the data and maximize the signal to noise ratio or minimize the lag in several different ways. And these are indicators that have not been published. And so they're private to folks who attend the workshop. We'll also talk about robust trading strategies using daily bars, unique things that are not available to the public, and intraday trading strategies. These intraday trading strategies are intended for the index futures, and they are turnkey strategies that when you leave the workshop on Monday morning, you could put them on your computer and start trading them with confidence. And probably with a reasonable amount of luck, and don't forget luck is part of trading, that you could pay for the attendance of the workshop just by trading out of it using these indicators. So in the syllabus, as I said, we'll be talking about the structure of the data. I'll go into filter theory because the theory is built into indicators. Indicators are really filters of a special kind, and we'll be developing these indicators and show you how to measure cycles. But in all of this little picture on the graph, what I'm going to try to do is to get your mind away from the squiggly lines, like you're seeing that sine wave being generated, and that's in the time domain. I want to get your mind into what's happening in the frequency or the phase domain, and they are equivalent, entirely equivalent, but it's a different way of thinking. So if you can think about partitioning in the frequency domain, you can see where the noise is occurring, and you can see the signals and how they're occurring and how they're changing and how to take advantage of them in your trading strategies. So again, we'll have, and I emphasize robust trading strategies. These are strategies that work out of sample, and both on daily bars and on intraday day traders. So in summary, that workshop will feature left brain concepts for traders in their right minds. Here is a comment from an attendee last year. He said there were lots of aha moments. So if you want to read more about it, there's a link on mesasoftware.com at the workshop. So please read more about it or email me if you have any further questions. And as Jerry said, another new thing that's on the horizon is a leader-follower concept where you can follow my trades precisely. I'm placing my trades with Jerry. Through this leader-follower concept, you can have my exact trades on trading ES in a day trader. It'll trade almost every day on the average. That would be a wonderful opportunity if you don't feel you want to do the analysis yourself. and you just want to follow my trades, it'd be a nice opportunity to do that. I'm ready for questions at this point.
Right. Andrea has a couple of questions here. Which book is the Rocket RSI in?
Well, for sure, Rocket RSI is not in one of my books. It's in a stocks and commodities article fairly recently, within the last year or two. Caught me there. I don't have the issue, but if you're a subscriber to stocks and commodities, you can search on my name and you'll find it easily.
Okay. Andrea asks, according to this code, would we still need to populate a value for RSI length, which is half the dominant cycle, correct? Is there easy language code in one of John's books for a function which would return that input for us?
No, that's a user input. That gets, from there, it would get into an issue of automatically tuning, starting with, say, measuring the spectrum using a MESA algorithm, and from that extracting a dominant cycle and using that dominant cycle to tune the filter. I'm not necessarily, I think it's probably better to use it as a user input, actually. I don't recommend that secondhand tuning. And the reason is the cycles are always changing. And by the time you measure them, and that's a lot of delay right there, and you tune the oscillator using that delay, the cycles probably have shifted out from under you. And it's probably not a good idea simply because of all the delays involved. Think of it this way. If cycles were constant in the market, just over 1 or 2 cycle periods, and then they were kind of like a pure cycle, every trader in the world would see them and they'd jump all over them. In fact, I think that's why they go away, because a lot of people do exactly that. They see the cycle developing, they jump on it, and that causes it to disappear.
Being down here, does John have this indicator for sale up for TradeStation? I don't know how to use easy language. That's from Bud, but you can get him the text file and he should be able to just import that.
Text file, or convert it to, if you're on some other, familiar with some other language, or if you're can't program or don't want to program, probably a better solution would be to follow me on the user leader follower.
All right. Jack asks, what about using the autocorrelation periodogram to calc the half span for the look back?
That's of all the techniques that are commercially available or available in the open source, I would recommend the autocorrelation periodogram. And that is because that the autocorrelation function eliminates this fractal effect of spectral dilation. It takes that out of the data. That's one of the things we'll be talking about in the workshop. If you're going to do it, that would be the one to use, I would recommend. But my previous comment still holds that it takes like a half a cycle or a cycle's worth of data to make the cycle measurement in the first place. And by the time you get the cycle measurement made and applied to the Rocket RSI, that cycle is probably gone and shifted out from under you. And so you use it with some trepidation. I think you can recognize the cycle by the methodology I described and act more or less in real time doing that.
Andrea also asks here, will the intraday trading strategies covered in the workshop also work on intraday equities, or really just on futures indices?
My techniques are universal. That is, it's a universal science that we're talking about. So they would apply to gold or equities or bonds or crude oil or whatever, or corn even, any of the agriculturals. What I'm talking about are fundamental primitives of an approach to technical analysis. So it's fully applicable to any market.
Adam asks here, what additional filters do you use to distinguish a low Rocket RSI reading from being a bottom or just low before the market goes even lower?
Again, I'm looking at the extreme swings to the downside, to the negative side. If it swings -2 deviations, I know that the statistics tell me that it's got a 97% chance of reversal. Now, it may be tomorrow, and it may be 3 days from now, and I may be in a little early, but there's a high percentage of a reversal. And if you're guessing in advance, that's the risk you have to take.
Neil asks, so what number do you use for bars back?
Bars back is a terminology in TradeStation for their strategies. Indicators don't use bars back, and it's simply to make their strategies not crash. Bars back doesn't apply. On daily data, typically on indices, I would use somewhere between 8 and 16 or 18, somewhere in that range.
Ken has a couple of items here to introduce. He says, traders.com, stocks and commodities, 2018 May issue includes traders tips of code is where you can find the Rocket RSI article, I believe. Traders.com, stocks and commodities, 2018 May issue. So thank you.
Thanks, Ron. Thank you,
Ken. Sammy asks, are your programs geared for TradeStation only?
Yes. I'm a simple guy. I started out programming in BASIC on a timeshare computer years and years and years ago, and converted to Fortran, and I'm an old dog. I don't learn new tricks, and I learned easy language. It's a variant of Pascal, and it reads like English, and so I've been programming in that. And I just don't need another language, although there's a lot of new good ones out there, better than, depending on what figure of merit you want to put on. I just am comfortable with it. And just an aside, when you program in a language, it affects the way you think. Because of my Fortran background, I think sequentially. I've found, and it's becoming more apparent to me talking to other programmers, that the way you think is influenced by the language you use. And so, kind of interesting observation on the side.
Neil, in a follow-up question regarding the bars back, he says, what is the length you use in the RSI?
Well, it's variable depending upon current conditions. As I said, it would be usually somewhere between 8 and 16 or 18, somewhere in that range, typically, on daily to bars. And it's a whole different issue on day trading. On intraday trading, I am hard over on the concept that you have to de-gap the data. The gaps have a 1 over F noise spectral density that affects your trading, and you can for sure make trading systems including gaps. But if you're looking at indicators like RSIs, you got to get rid of the gaps. And so day trading, to use it, the first step you have to do is de-gap your data.
And finally here, we're right on the 45-minute mark. Andrea, again, does the $6,000 cost for the workshop include hotel, lodging, and meals?
No, it does not.
But it does include lunch, right?
Oh, yeah, sure. We got all the breaks and lunch. And Saturday night, there is a banquet that I host. Some of our local wines, favorite wineries, will be front and center on the menu too.
Very good. So it's well worth the effort here. Let me go ahead and, okay, excellent. Well, I want to thank everybody again for spending the time with us today. I hope you got as much out of John's presentation as I did. It's always great to hear from him. If you have any questions, here is my contact information. Please feel free to give me a call, send me an email. More than happy to get what you need. John also had his email up there. I can certainly get it for you as well. I mentioned earlier in the program that since Simeon was in John's backyard, well, not literally, this is literally John's backyard. You want to just have a couple of words about what we're looking at there, John?
Well, as Jerry said, literally, that's my backyard. That's my office area. Cambria is known for its Monterey pine trees. You see those huge monsters in the background. they are kind of prone to falling over in a big storm. So they're beautiful to look at, and really delightful at dusk when they're silhouetted. It's magnificent. So yeah,
Right.
literally that is my backyard and my office area.
Right, and this is a picture that John has his. I've had the fortunate luck to be able to attend the last 3, I believe, of his workshops, and this is a shot right off the back of the little area that we have the meeting in, so you can kind of see what type of environment we're working in for those 3 days. It's pretty intensive, and it's a lot of material, a lot of information, but he does have follow-up sessions with everybody, so you know that you do have some support in that kind of thing. So I just kind of wanted to end the webinar with some interesting visuals there. But again, I want to thank everybody. Please feel free to give either John or I an email if you have any questions, and hopefully we'll do this again real soon.
Thanks, everyone.